Welcome to Friday Takeaway. We are taking a look at insurance companies, specifically Takaful and Tune. But before we get into that, Huawei is suing the US government over a law that bans government agencies from buying their products. Trump's administration has put the pressure on Huawei and ZTE specifically, and Huawei is apparently not taking it anymore. Huawei now says the ban is actually against the US Constitution, saying that the government should not single out an individual or group for punishment without due process. Whether it works? Well, legal experts are sketchy, but it's clear Huawei isn't going to go down without a fight. In general though, Asian markets had a bit of a sluggish week because global growth worries resurfaced and US equities lagged. The yen had a good run though, and JP Morgan actually called for a buy on the ringgit as it could very well benefit from the US-China trade deal. Stocks further felt the pain as the ECB turned more cautious than some had expected, now saying that it doesn't expect to lift interest rates at least until early 2020. And it launched the third round of its cheap loans program. Mario Draghi's ECB/macroeconomic forecasts, reducing 2019's GDP forecast from 1.7% to 1.1%. Back at home, Bank Negara kept its overnight policy rate at 3.25% and that they expect the economy to keep to a steady growth this year. Driven mostly, the central bank says, by the private sector, and inflation should remain low in the immediate term. In this week's This or That, we take a look at the insurance sector, namely the only pure Takaful player, and the other one that is a little more of an upstart. First up is Syarikat Takaful, which saw a record net profit for its fourth quarter. But does that mean that continued better times are ahead? On the other side is Tune Protect, where AirAsia is a shareholder which has done some major house cleaning. But with new CEO Khoo Eileen at the helm, is the worst over? Both are going into an environment of uncertainty, of possible increased regulation, but there are some bright spots too. So, who will fare better? Let's pair them off. The only pure listed Takaful player in the country, Syarikat Takaful, is 60% owned by BIMB Holdings. Actually, it started out as a task force by the government during the 80s. Today, its total assets stands at 8.9 billion ringgit as at the end of last year. It has 25 service centres and offers, like its name suggests, family and general Takaful business in Malaysia and Indonesia. Syarikat Takaful actually had a great 2018, posting a record net profit of about 295 million ringgit, which is about 42% jump from the year before. This was because of higher sales from its family Takaful segment, which contributes 70% to its gross earned contributions and lower than expected claims incurred ratio last year. MIDF Research believes that the group's digital strategy and prudent underwriting are the reasons behind the strong growth. It actually upped its FY19 forecast by 25% amid continued strong momentum for the group's business. UOB Kay Hian says strong premiums growth will continue in 2019 because that will mark the full-year contribution of its bancassurance tied up with Bank Rakyat, and bancassurance is 55% of Syarikat Takaful's family Takaful premiums. Looking at the bigger industry picture, the government announced initiative this year to give monthly tax rebate of 250 ringgit for life and Takaful insurance products. But analysts do warn that the players will have to deal with increased regulation, which could put more pressure on margins, which means less breathing room. Its Indonesian ops continues to have issues. Its loss before zakat and tax widened to 5.1 million ringgit for FY18 due to higher expense reserves, because it is kneecapped by the concept of promoting Islamic products practiced by the more conventional domestic player. Finally, its latest dividend payout was actually below the group's 3-year historical average of 50% of the profit, which isn't the best news for shareholders. In fact, Kenanga Research called its interim dividend of 15 cents a miss, as it was 2 cents below what was expected. Its share price rose to an all-time high of 4.60 ringgit on February 13, following the announcement of its record profit. But profit-taking has brought that down a little, and more recently it's been hovering between 4.50 ringgit and 4.60 ringgit. Analysts though really love the stock. All 7 of them on Bloomberg have a buy call with target prices ranging between 4.40 ringgit and 5.82 ringgit. Formerly known as Tune Inc. Holdings Berhad before 2015 and listed back in 2013, it has 20 branches nationwide that sell non-life insurance coverage products that include protection for travel, which it is best known for, accidents, online motor insurance, and even dental. And of course, it has a strategic alliance with the AirAsia Group, which is how it boosted its database to more than 7.5 million policyholders from around the world as of 2013. Tune's results for FY18 were actually marginally better. Profit was up about 6.5% to 49.3 million ringgit on the back of higher revenue of 566 million ringgit in FY18. But it should be pointed out that it did some housekeeping. Tune booked the cost of 3.7 million ringgit for its VSS, and this higher management cost offset the improvement in net claims for 2018. Because if you took out the VSS cost, Tune's net profit could have actually increased by 5.2%. Besides the other worries about regulation, RHB says that the insurance industry would most likely be affected by the slowdown in the Malaysian economy. So, it believes that the earnings recovery would be gradual because the industry is so challenging at the moment. Clean slate, new direction. New CEO Khoo Eileen has set an aggressive 3-year target with plans to increase the number of digital contracts to 42 million over the next 3 years. She says this will be driven from the expansion in the offline travel insurance market and having more tie-ups with insurance partners in other countries, namely Indonesia and Vietnam. It also wants to enhance its dynamic pricing 2.0 initiative and new products such as its pay-as-you-drive motor insurance. Taking a look at its 1-year share price, the stock fell to an all-time low of 53 cents on December 20th last year. It's been hovering between 60 cents to 70 cents since the beginning of the year. Overall, analysts have 3 buys, 4 holds, with target prices ranging from 63 cents to 1 ringgit 10 cents.